NVIDIA stock is currently trading live at $202.82, down 2.58% in today's intraday trading session on June 10, 2026. The stock opened at $204.43 and touched an intraday high of $207.22 before tracking downward to a session low of $201.61, amidst a broader technology sector pullback driven by escalating macroeconomic tensions and a surprise tick upward in the latest consumer price index data. While a daily drop of nearly 3% might cause temporary panic for casual retail investors glancing at the Robinhood app, the institutional capital is watching an entirely different set of numbers develop behind the scenes. The big surprise today isn't this minor price correction, but rather the massive, quiet accumulation of shares by hedge funds during these exact dips, completely contradicting the mainstream narrative that the artificial intelligence hardware trade has run its course. Everyone in the retail trading space seems focused on short-term margin fluctuations, while the largest asset management firms are aggressively locking up supply because they recognize that hardware spending is transitioning from speculative buildouts into deeply integrated global infrastructure. The common belief holding back the average investor right now is that NVIDIA stock has peaked, that its massive valuation makes it a dangerous game, and that competition from other chip makers will inevitably erode its pricing power. You see this sentiment echoed across popular investing sites and retail forums, where people argue that the low-hanging fruit has been plucked. But the contrarian reality is that NVIDIA is no longer just a chip designer. They are building entire proprietary computing ecosystems that tie customers into long-term hardware and software dependencies. When you look past the basic stock charts on standard online investing platforms and examine their newly announced technology partnerships, like the multi-year agreement with SK Hynix to co-develop memory for the upcoming Vera Rubin architecture, you realize the gap between this company and its peers is actually widening, not shrinking. This isn't just about selling a graphic processing unit anymore. It is about establishing a sovereign chokehold on the next generation of global data center architecture. Looking at the immediate price action over the last few weeks, the stock has been consolidating in a defined range between $195 and $225, shaking out weak hands who bought near the all-time highs. Trading volumes today are tracking close to 73 million shares, showing significant liquidity and heavy institutional participation as the market digests the newest macroeconomic data. When consumer price inflation registered at 4.2% annually this morning, it triggered an algorithmic sell-off across high-multiple tech giants, dragging NVIDIA stock down alongside Apple stock. Yet the underlying corporate demand for NVIDIA systems remains decoupled from traditional consumer economic cycles. Large enterprises aren't pausing their data center expansions because inflation ticked up 0.5%. They are accelerating them because computing efficiency is their only path to reducing operational costs over the next decade. If you open any advanced self-investing portal or check the asset flows through major brokerages like Fidelity, you'll notice that thematic technology funds are experiencing continuous inflows despite the daily market noise. Institutional desks are using this specific dip to rebalance their portfolios, rotating out of defensive sectors and building larger positions in secular growth leaders. This institutional activity shows that the smart money treats these macro-driven pullbacks as a gift. While a casual user on a basic online investment account might sell out of fear, sophisticated managers using tools like Schwab Intelligent Portfolios are systematically rebalancing into these structural winners because the long-term earnings math remains incredibly robust. Let us unpack what this business actually does and how its operational engine functions. NVIDIA operates primarily through a fabless manufacturing model, meaning they design the highly intricate architecture of their processors and outsource the actual physical fabrication to specialized semiconductor foundries. This allows the company to remain asset-light, avoiding the billions of dollars in capital expenditures required to build and maintain advanced silicon manufacturing plants. Their primary revenue engine has shifted dramatically over the past few years from consumer gaming graphics cards to high-performance data center systems. These systems combine specialized hardware with a proprietary software layer called CUDA, which developers use to optimize computing workloads. This software integration is the real moat, making it incredibly difficult for an enterprise to switch to a competitor's chip, because doing so would require rewriting millions of lines of proprietary code. Historically, the market viewed NVIDIA as a cyclical hardware cycle, prone to dramatic boom and bust periods tied to gaming upgrades or cryptocurrency mining trends. Older financial reports from several years ago show wild swings in revenue based on these consumer patterns. However, their strategic pivot toward corporate infrastructure transformed the financial profile of the business. The company's recent earnings reports have consistently shattered expectations, driven by data center revenue that now accounts for the vast majority of their total sales. This structural shift is why traditional valuation metrics often fail to capture the stock's true trajectory. When an investor looks at a trailing price-to-earnings ratio on a standard individual brokerage account, they are looking backward at a business model that is rapidly scaling into a recurring infrastructure platform. Comment below how many shares of NVIDIA stock you currently hold in your portfolio, and whether you are buying more or holding steady through this week's volatility. It is always fascinating to see how retail positioning compares to the institutional block trades we track on the professional desks.
Looking toward the future, the forward outlook for the company hinges on several distinct catalysts and risks that will test the expectation versus reality dynamic. The most immediate catalyst is the global rollout of their next-generation chip architectures and the build-out of regional sovereign data centers in international markets. Recent commitments from major telecom and cloud providers in regions like South Korea to build out gigawatt-scale computing facilities using the proprietary NVIDIA architecture highlight a massive, untapped pipeline of international enterprise demand. These sovereign entities want independent computing capabilities, and they are willing to pay a premium for verified hardware ecosystems. This reality could easily outpace the conservative consensus estimates currently modeled by Wall Street analysts. However, navigating this landscape requires a clear-eyed assessment of structural risks. The primary threat to the bullish thesis isn't a lack of demand, but rather geopolitical friction and supply chain concentration. Because the physical fabrication of these highly advanced designs rely heavily on a limited number of manufacturing facilities in East Asia, any disruption in regional stability or international trade policy could instantly impact supply. Furthermore, export restrictions imposed by domestic regulators can abruptly cut off access to lucrative international markets, forcing the company to design modified, lower-performing alternatives for specific regions. This tension between global demand and geopolitical reality is precisely what creates the sharp, volatile swings we observe on platforms like Interactive Broker Stock Trading or the SoFi Active Investing interface. Another factor to watch closely is the evolving capital expenditure budgets of the major hyperscale cloud providers. The current market expectation is that these tech giants will continue spending aggressively on infrastructure indefinitely. The reality, however, is that these companies will eventually face pressure from their own shareholders to show tangible returns on these massive infrastructure investments. If cloud providers begin to slow their pace of deployment to digest their current capacity, NVIDIA could experience a temporary cooling in its order book. This wouldn't mean the long-term thesis is broken, but it would cause a sharp recalibration of the stock's multiple, presenting a stark contrast to the unbridled optimism often found on popular investing sites. For investors managing their own accounts through Interactive Brokers Trading or utilizing specialized automated tools like a SoFi robo-advisor, the key is separating secular execution from short-term macroeconomic noise. Daily fluctuations driven by interest rate expectations or geopolitical headlines will always create short-term volatility, but they rarely alter the structural earnings power of a company with this level of market dominance. When evaluating your exposure across various investment vehicles, whether you prefer individual stock selection via a Fidelity trading platform or broader exposure through Fidelity ETFs, understanding the underlying mechanism of corporate spending is what prevents emotional decision-making during sector rotations. To wrap up our analysis, the central insight here is that the market is currently pricing NVIDIA based on a temporary macroeconomic slowdown and standard tech sector profit-taking, while ignoring the massive structural tailwinds of international infrastructure expansion. The expectation among skeptical retail traders is that the hardware cycle is cooling off and competition is closing the gap. The reality is that the company's aggressive technological roadmap, backed by deep memory and software integrations, keeps it steps ahead of the competition, while institutional accumulation points to sustained long-term confidence. The current pullback to the $202 level reflects a broader market correction rather than a fundamental flaw in the company's operational trajectory. Investors who focus on the underlying infrastructure narrative rather than the daily noise on their mobile apps will be better positioned to understand where the real value is being generated as this computing transition continues to play out across the global economy. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Buy, comment, and share this video to support the channel.